that anti-dilution protection kicks in for the entire shareholdings of the previous investor. It's called full ratchet. It's awful, and it happens all the time. Board of directors seats, normally the investors, the Series A and beyond, are going to seek control of the company. And they're going to assist in the management of the company by sitting on the board of directors. There's something called a shareholder purchase agreement, which when an investor makes an investment, he gets the right to sit on the board. And then the board has rights to hire and fire the executive team, approve major capital investments, approve the operating plan. It goes on. And this is again an example of where, pardon me, let me back up here. There's also preemptive rights of first refusal. This means that if the company wants to bring in a new investor and negotiates the terms to deal with that new investor, they have to first show it to their existing shareholders, who can then say, I'll take that deal. The existence of this agreement, this right of first refusal, makes it very hard to persuade investors to go through a due diligence process if they think that they'd make a positive decision to invest, and then the existing investor is going to shut them out. So you don't want that. Business approvals. The board, the purchase agreement includes approval of additional stock option plans, includes information rights, these are financial statements and all the rest.
So the board of directors has the right to hire and fire the executive team. So how does one protect themselves from being fired?
You can.
Right, you can't. Okay.
Well, you mean you can. You could draft a document that gives you that protection. But practically speaking,
Not really possible.
I mean, you can try to sue the board for
So
firing.
when do you kind of lose that control of the company, or you never really have it? I guess.
Well, no, that's a very good question. You do have control of the company at inception. The terms that you agree into subsequent to that determine usually a diminished level of control. Ordinarily, this is, but you might see a deal where the investors get to choose three directors out of a team of 5. And so, and the purchase agreement, the shareholder purchase agreement says, this investor shall have the right to appoint 1 member of the board of directors. Bingo. There it is. The company, the VC investor might say, but we reserve the right to fire the CEO, but that'd be a hard term to extract. And that's just another dimension of the risk involved in these prospective high return ventures.
How commonly does that actually happen?
The CEO is a fairly high risk position. I speak with experience, but nobody wants that to happen. The last thing the investors want is to have to fire key members of the management team. That means there's something that went really wrong, and now you have to find new people, and it's probably a pivot or a restart. It's not a desirable outcome, and it's not a likely outcome, but it's in the can happen category. But it's another reason we're trying to have an amicable and fair, level-headed, calm relationship with your investors. As I write, in caps, it is essential that a new venture maintain a trusting, mutually valuable, and profitable relationship between founders and investors. Keep that in mind from day one, and all these things can proceed very strongly, very much according.
I think the corollary to that is don't take money from someone who you don't want to be a partner for a long period of time. Because there's going to be bad spots, you know, so.
Yeah. If the CEO got fired, does he also have to keep his common share? Does the former CEO still keep the share?
That's a good point. It depends on the employment agreement that they have with the company, and there usually is. And it determines what happens in the event that the executive is fired. And it varies whether if the worst case is they get fired for what's called for cause, which means like cheating, lying. Other terms of separation of an executive can be more reasonable, less painful. But generally, to the extent that your stock options have not yet vested, remember I said they vest to you over a period of years, you usually lose the unvested portion of it. But again, this can all change. These things I'm describing to you today are sort of the norms, but there's a big standard deviation around the boundaries of what I'm describing here.
Would the high percentage of the CEO or CTO, would that maintain once if one of them kind of kicks off?
Well, remember that percentage described stock options that they, are you talking about the founders or the?
The founder.
Okay, the founders, I'm thinking of deals I've seen. If the executive is seeking to preserve an unreasonable level of ownership in the company, it's likely that they could be dismissed. Again, this all relies a lot on the sense of partnership that you have with the investors. But they're not going to be able to grab back founders' stock, shares you already purchased. They may be able to issue large amounts of new shares, which could severely dilute you, but it's going to dilute all the other shareholders as well, so it's not too likely.
And if the founder is not a CEO or either one, the CTO anymore, would they have a lot of stock shares?
The company's going to have to issue new stock options to attract somebody to replace them.
Does that dilute the VC shares too?
Everybody.
Or there's, okay, so theirs aren't non-dilutable.
Well, there's that anti-dilution provision
Right.
that I mentioned.
So they could just keep adding shares if they have that and they don't care because theirs are never gonna go down?
Well,
It hurts.
I'm sorry, say your question again.
But like if, in some case where they needed more shares because they needed to have a new investor or something, their shares don't go down, so yours just go down. If there's only you and investors and there's no other people shares.
You, the common shareholder, usually do not have dilution provisions.
Something has to dilute if you're gonna offer more shares.
Yeah, it's gonna be the common shares that get diluted.
If a relationship with investor does go sour, how do you deal with that? Is there any way of getting them out of the company?
You try to deal with it as adults that don't want to create any more wreckage than has already been created, and look to some kind of an equitable, if painful, compromise.
I mean, you just get lawyers involved. How do people handle that?
Yeah, well.
Do you buy the portion back from them potentially? Or?
As a matter of fact, a very common form of stock option has a buyback provision in it. And where that works is you receive an option that's going to vest over 4 years or so, but it's what's called an immediately exercisable option. So you can exercise it the day you join the company, but it's subject to buyback. The shares can be bought back by the existing investors. Which, makes a fair amount of sense.
but typically the reason it's hard to buy back the shares from your investor is you have to come up with the cash now, right? That's the hard part, right? If you had the cash, you may not have needed the investors.
Oh, so you're saying that if let's say you're working with someone who initially helped you launch your product, and that relationship went sour for God knows what reason, and then at some point you're successful enough that you could buy back whatever shares they were, you have the option of doing that?
Usually.
Okay.
But maybe at 2x what they put in. I mean, right?
Yeah.
That's where it gets
Yeah.
tricky again. Now, there's sort of this whole evaluation concept of you're pushing them out. You're not a public company, so the stock price isn't listed. You can't do the simple math, and they may not be too happy with you anyway. So it can be very contentious.
Mm-hmm.
Yeah, which is to be avoided.
Yeah.
And it's easy to get contentious. There's gonna be, there will be instances along the way where you decide that your co-founder or your key employee is a real jerk, and they just won't listen, or whatever. And you'd have to be able to kind of skate through that, and take a long view, be the adult in the room, if that's what it takes. So, a little talk about management of venture risk. You could be asking, well, why would I want to do this with all this risk that you're describing? And it's true that the risk in new ventures is real and unavoidable. More than half of new ventures fail. Very high investment returns, and this is one of the laws of the universe. Very high investment returns always are accompanied by high risk. Many people will shake their head yes on this, but they'll say, but that applies to the other guy in these statistics. That wasn't me. That's the rest of the venture capital community. But if you really want to be realistic, this risk comes with high returns. The smartest and one of the smartest investors I've ever had, one of the most reasonable, was in a deal that didn't work out. And he said, I expected very high returns, and I know that comes with high risk. And we'll go forward. Now, how did VC funds manage this risk? Because we said that maybe 2 out of 10 deliver attractive outcomes. Well, the way they make up for it is by diversification across a large pool of investments. They'll raise a fund of, say, $500 million, and they'll expect to fund 10 businesses with that. And they know that they can't know which one is going to succeed, or they would have chosen that one as the only one to invest in at the outset. So they have to spread the risk across multiple companies. So that works for them. That's the model of the venture capital industry, and it's a mature model. But what about the entrepreneur? What do you do in the face of 2 out of 10 chances? Keeping in mind that that's not the other guy, that's you. And that is that you also need diversification. You can't rely on one outcome, because you can't know what that outcome's going to be. You have to participate in multiple ventures, and the way you do that is over time. This requires that you view the whole process here in a very different way. It's not a deal, it's not a company that you're trying to launch and make a big payoff on. It's a way of life, it's a career. And if you stay with it for 30 years, someone like myself, now you have diversification that's timeline, it's serial entrepreneurship. And it's every bit as valid as is the diversification that a venture fund has that invests in multiple companies. So that you can manage the risk to a reasonably low level. Just understand that we might score your first hit in 5 years or in 20 years. And that's why it's important to be taking out a livable salary, be taking out reasonable benefits the whole time. You can do this. These terms are available and commonly available. So view it as a career. View yourself as an optoelectronics entrepreneur, and that you're going to work most of your life. People who become instantly rich still have to fill their time. You're going to want to stay active. You're going to want to be in the game. And so, over time, your odds are just every bit as good as the VC funds, as far as VC funds. So it's a path. If you stay on that, you can anticipate great outcomes. Questions?
So, just to understand it right, as an entrepreneur, you're always the founder of the company, and then after some point you say, okay, I'm not going to be in the company, and then you go and start a new company, or?
Oh, yeah. There's going to be an outcome. The company is going to fail, or it's going to succeed. If it succeeds, it's going to be taken public or sold to another major corporation. And that's it. That's the process. And by the way, it's not black and white. It's not failure or great success or a zero outcome. There's a range of outcomes, and at least half of them are very attractive.
I'm just curious, what would you say is the biggest difference between, either the products or companies or entrepreneurs who make it versus the ones that don't? Like, if there's like one or two common.
Well, I think the biggest mistake is with respect to market size. That the demand, the fundamental demand for the product's value proposition isn't there, isn't what you hoped it would be. The second would be a failure of management, failure to manage the enterprise. Third would be a failure of the technology. The technology didn't work, or didn't work good enough. And that's another whole topic. The technology that it takes for a startup company to displace a major equipment manufacturer like Cisco at a big carrier like Verizon are huge. You can't come in and say, I'm giving you 3 dB of improvement. And in a CDMA network, that's double the capacity of a CDMA network. Why would you not want this? Double your capacity just by adding 3 dB, and it's known forward error correction technology and blah, blah, blah. Well, then they talk to Cisco, and Cisco says, we're 6 dB ahead of that in what we're introducing next spring. And that just might be true, by the way, but it's hard for you to prove it if it's not. You need to come in with really big numbers, 5x, 10x. Doubling things is not enough to displace entrenched, competent competition. But that's what's good about the area of science that you people are in, is that breakthroughs are possible. Things that can't be done in a lot of other sectors are possible. They're not easy. They're difficult, they're exciting, fun technology. And there's plenty of room for innovation out there. Just be sure at the beginning that one, the potential market is big, and two, that your value proposition is huge. So that means be very selective on your own behalf.
What do you mean by that, value product, the value product?
The value proposition, it's a $100, somebody wrote a $100 word for value. But it's, the value proposition is the price, the performance, all of the above, the reliability, that in total provides some level of explicit monetary value to the customer.
So, you feel like the difference is that, people will underestimate or overestimate, the market size or the value of that product in the market?
Yeah, I mean, the biggest mistake is the market wasn't big enough where it wasn't available to new entrants. And the second is management. All this assumes, everything I've been saying here assumes competent
Same as
management.
what you said,
eventually.
right? Number one.
And then the
thing
third is the one that's
customers.
sort of most disappointing, and as certainly for me, is when the technology doesn't work.
Or doesn't scale.
Yeah.
Doesn't scale, or it's not manufacturable. And I'm a big fan of university technology transfer to the private sector. And that's the one area, though, where I've had unfortunate surprises, is the technology really didn't work. And sometimes for reasons that we could have foreseen. This was a company. It happened to be a company where the technology came from here. So I'm not going to go into the details. But all I can say is that after the fact, we knew why it couldn't work, and could have known. All this reflects the need for, I used the VCs use the word due diligence. It's care, it's honesty, it's selectivity, it's thoughtfulness. All these things that we as human beings can be really good at. It's just a matter of discipline. Okay.
So you're saying, Franz, that you use Shia as one of your validators of the due diligence, meaning, you ask professors, others to say, is this something that's viable technology?
Sure. I mean, this is just individually, as I say, I'm a big proponent of tech transfer, and so been fortunate enough to make many friends here at UCSD and at UCLA. These are distinguished scientists whose ability to call an idea great or stupid is unquestioned, and who, by the way, lets you know where they stand on it, and they're a pleasure to work with. Well, thanks very much, everybody. This was great fun.
Well, it's been a long day, and so this basically concludes our today's activities. See you all tomorrow at.